holding 32 stocks eliminates 96% of the risk.
Emotionally, being concentrated is quite a ride, boys.
In my penny stock bucket, no more than 10 stocks ever.
You know how to trade options. If you understand how the US markets move, why not do both?
This statement might kind of trigger some listeners, but this is like directly from the Oracle of Omaha himself.
What's up, guys? Welcome back to the channel. This is episode 3 of the Beyond the Edge podcast. Usual suspects, we got Peter Palarchio, Declan O'Flaherty, but we also have a new guest, Dan Kozel. He's been in the small and micro cap investing game for a long time. Very knowledgeable guy. Also has his own podcast, New Gen Mindset. Check it out. It's a wicked podcast. So Pete, Declan, thank you for coming back. Dan, thanks for joining us. You guys ready to do this?
Yeah, great to be here.
Yeah, super stoked. Let's do it.
Good. We'll work on the enthusiasm, but okay. If you're watching this, you guys know the drill. We're going to kick it off going over 3 news articles from the Sunday Snapshot. We're then going to do a brief little, I don't know if I want to call it an educational session, maybe it's a debate, just a little bit of a discussion around concentration versus diversification. Then we're going to do what's, not a company pitch, because I think everyone on this call already loves the stock, so maybe it's more of a discussion about versus. So without further ado, let's kick it off. First article is about NIO, giant Chinese electric vehicle company. One of those stocks that it seemed every YouTube influencer was covering about 2-3 years ago. A lot of hype around this. It had some pretty major news, actually. World's longest battery life of any electric vehicle. I think that's the quote. Over 700 miles. Over 1,000 kilometers, depending on your unit of measurement there. Pretty significant. Mind you, it was a bit of a cherry-picked, setting. It was a fairly cool climate, fairly slow speed. But nonetheless, let's give credit where credit's due. That's an impressive feat. So let's talk about the company itself. Declan, why don't you kick it off? What's your view on NIO? You don't have to go a deep dive analysis, but do you have any high-level thoughts on this company?
Yeah, for sure. I mean, so the news definitely brings more notice and attention to the company. I had some familiarity with it before, just looking into the EV space. Overall, the financials have not been too stellar, but it has a solid cash position. And then, just speaking from the industry at large, really the battery technology sets a new precedent, and it's a question of, in this current state, how investable is the business? Is this new information really going to translate to value for the company and improve its value overall? That's kind of where I'm at. So time will tell, but definitely curious and interested about the business nonetheless.
Certainly. Anyone else here with strong views on the company that just wants to jump in next?
On the company itself, no. Do I trust the study? No. I think I'd like to see a little bit of a deeper dive rather than a press release. I'm not a scientist or any type of engineer myself, but this thing had to be downwind in the perfect climate. You have a lot of companies that have been in the EV space looking to do things like this. So I'd like to dive a little bit deeper into some of these results. Elon Musk shoots things into space, which is basically one of the hardest things mankind can do, and hasn't really been able to push those limits with a lot of funding and a lot of technology and a lot of the world's most brilliant kind of scientists and engineers behind him. So I'm skeptical a little bit at first, for sure.
I think that's fair.
Yeah.
I mean, and the other question is, does the world need a 1,000K battery?
Exactly. Well, I'll make a comment kind of building on that. Like, if you have to go repair your electric vehicle battery, what's the average retail price for that, right? It's almost like $20,000 or $30,000 for a battery. So you kind of have to be skeptical there. The other thing too is, like, I don't know if you're going to want to own an electric car where there's like, negative 30 or minus 20 degree winter, then your car's not going to start. So, I'll piggyback off Pete here. I'm very skeptical of those results as well, for sure. From the stock side, it looks like it's probably bottom, but we've got to see if they can deliver on what they say they're doing these next couple quarters.
Yeah. Who's bullish on EV and going to 2024 and beyond? I'm curious. Any of you guys? I know, or have we kind of seen the whole lithium EV run its course?
I would say I'm not bullish on it anymore. I mean, you look at some of the like US funding is disappearing, increased competition. Fuel is certainly not cheap, but it's cheaper than it's been in recent months. So it's that kind of removes some of the incentive. And the world, like the consumer is not okay. Like people are hurting. And I think the idea of paying a premium, this battery alone is worth, what is it, as much or more than the car itself? It's so expensive that they don't even sell it to you. They offer battery as a service. So you actually get a car with no battery, and then you choose your battery pack option, and then you pay a monthly lease for it. That's how expensive these batteries are. So a consumer that's already stretched to the limits, are they going to be, dying to go out and buy a premium priced vehicle? I have my doubts, I suppose.
Yeah.
Mr. Fundamentals, do they have any control on that financing? That's interesting.
You know what? I haven't looked deep enough into it. But just one note to add to from like Kev's side of things is another thing you got to start keeping in mind when it comes to the companies like this is around the Inflation Reduction Act and the incentives imposed by the US government. And so a big part of that now is, well, they want producers of battery materials to be located within North America or allied countries, and or those at least that are willing to comply with the rules around meeting those requirements. And so one thing right now is this is a Chinese EV company. So how much impact or presence will they have in the North American market is really to be discovered in these coming months, because if they can't even penetrate it, what kind of relevance does it have here in competing with somebody like Tesla that has much broader reach and can really penetrate any market that it operates in?
I think a term you're going to have to get used to for sure, what Declan's referring to is friendshoring, right? That is certainly something that we're seeing kind of with the West versus kind of some of these BRIC nations, and EV, where a lot of kind of the raw materials are controlled and required to produce a lot of these things, are supporting, a lot of BRIC nations. So I think EV in general, going to 2024 election year, is very much a geopolitical issue. I think for good or bad, it's certainly kind of starting to fall down certain political lines as well.
Mm-hmm. Now, one thing to this stock's credit, I mean, you look at it from a valuation perspective, they're doing like almost $7 billion a year in revenue. So this is a big company. It's no slouch. So if you look at valuation compared to that, price to sales, it's like 2 times. So it's not an expensive stock by that nature. I think people are just nervous because it's a cash burning machine. Like it's a very expensive business for them to run, particularly because of the business model they've chosen. Like I said, you have to invest. They have to buy the batteries up front, which, as we've mentioned, are as expensive or more expensive than the whole car. Then they lease them to the consumer, so they don't get that. They're not getting money back on that for many years. Plus, they have to build these battery swapping stations. Plus, they need the infrastructure to charge those batteries. So this is like, and it's a company trying to expand globally. So this is a company just raising a lot of money. $2 billion from this Abu Dhabi fund. Recently, another $1 billion back in the spring. So they've certainly got money and they've got billions of cash on hand, but they're burning it like at warp speed. At this rate, I don't know the math on it, but I think they'd be out of these cash reserves in like a year or 2. So I think that's why it's trading at such what kind of from a top line revenue seems pretty attractive.
Mm-hmm.
So I'm trying to recap here. So we're saying consumer demand going the wrong way. Operationally, very worrisome. Testing out the studies itself on this record-setting battery, skeptical. What's the upside, guys?
Fair.
Yeah. One last point about it is that, you can kind of look at NIO as a company that is following the similar early stages as Tesla, but with one caveat: Tesla was disrupting the industry and really transforming consumers' mindset about electric vehicles. NIO is participating in that market now with also many other players. And so is the battery going to be the differentiating standpoint? So far it may have some merit, but it's not very strong. And then the financials don't actually back or prove that the company is super valued, or at least from an economic fundamental standpoint, like makes it tangible enough for it to last. So, yeah.
it just feels to be more like a publicity stunt than anything.
That's where my mind went as well.
Yeah. Who needs 1,000 kilometers? Like, do you need to be driving 14 hours straight anywhere? Like, who are you that you need to do this? Like, how far away do you work? I don't know. Like,
yeah, I think it'd be interesting, but Tesla's not doing that right now with a lot of great science and a lot of great experience and a lot of money behind them, and they're not anywhere near that.
Yeah. And guys, this is a $15 billion company, so it is slightly above the kind of our target of following companies 10 billion and below. But it was just news that was significant enough. We wanted to get it on there. But I don't want to spend too much time on it because I'm more excited to talk about the next topic. We're going into crypto. It's kind of no secret that the price of Bitcoin has been wildly strong this year. There are definitely people making money in lockstep. Obviously, adjacent companies like Bitcoin miners do well. So let's talk about Marathon Digital. They just had this mega deal. Let me get the exact number. It was $178.6 million cash to buy new Bitcoin mines. So massive acquisition. They claim it's going to reduce the cost of mining Bitcoin by 30%, which I will admit I don't actually understand how it can be that significant across their whole operations. But I mean, let's get into it. So, Dan, I know you've traded some options on Marathon. Is that a company you've followed along with since your options trading, or are you refreshing yourself now?
Well, I think you just have to go back to how Bitcoin was trading over the last 6 months because, and I'm putting my technical analysis hat on, the price action on Bitcoin from March till about end of September, it would just traded in this range. And usually when it trades in that range, there's a move that's going to happen because there's an accumulation period. It's kind of in a limbo. No one's really talking about it. And when I see that, I'm like, there's going to be a move here. I just don't know what it's going to look like. So you kind of have to position yourself accordingly. So keep that in the back of your mind. The miners, the way that they generate revenue is by mining the Bitcoin. That's literally how simple their entire business model is. There's a cost of energy, there's a petahash rate, and then of course there's their overall fixed overhead. And then whatever revenue they're generating, that's based on how many Bitcoin they mine. Mara and Riot are two big ones in the US. Over the last 2 months, we've seen an inflow from institutional capital of an increase. Like JP Morgan, I think, increased their position in Mara alone by 200%. So when institutions are slowly starting to pile into these names, and you've got the BlackRock situation with the ETF that's coming up, you got the Bitcoin halving coming up next year, I'm very bullish on what's happening right now. I just want to obviously allocate my risk. So for me, it's like, what is the smart money doing in this space? And they're buying. And they're buying a fuckload. So you want to participate in that market participation. And that's why you just play a little bit of the options and then take a look at what Mara's done. They have cash now. All these names now are going to come out and do bought deals because they have higher prices and they can continue to operate. So it's an interesting time, especially in this space right now.
But do you buy the miners or do you just go buy the coins yourself?
Sorry, what was the question?
In terms of a trade to make, do we if we're bullish on crypto, then do we think we get our exposure by buying publicly traded Bitcoin mining stocks, or just go open up a wallet and on an exchange and buy Bitcoin directly or a fraction of it?
I think it depends on your sophistication and sort of your level of expertise, right? If you're just a beginner, my favorite thing is just go on your CoinSquare account, go on your Coinbase account, buy Bitcoin, right? Just keep accumulating that. If you know how to trade options, if you understand how the US markets move, why not do both? I do 3 things, right? I got Bitcoin on a cold storage wallet, on a Canadian exchange, and I've also traded in and out of the stock. So I think it really depends on your level of sophistication and understanding of what's happening and your level of comfort too.
Interesting.
I think that's fair.
Yeah. I mean, just to bounce off that. So I would say that I take a pretty opposite approach overall, Dan. For one, I have no investment in cryptocurrency. Overall, I'm pretty hesitant on the asset in general. Where that comes from is as somebody who really like tries to focus on the fundamentals, and a large aspect of my strategy is trying to figure out what things are worth. I have no idea what these coins are worth ever. And then as that translate to a business like Marathon, their business solely depends on the success and performance of these assets. And, I'm not denying that there may be some potential, and it really can create the value that it seeks to achieve. But in that instance, like you're really banking on an asset that has limited tangibility being able to perform in a way that really, I believe like for it to really be successful, it has to be adopted, by the mass majority of people. And I just don't know if it's going to get there. So from a company standpoint, I am skeptical of any business whose sole operations depend on this. But then also from an asset standpoint, more than anything, I don't know enough about it to make a strong bet behind it. And that's why I'm sticking to the sideline for now.
Yeah, I think I've done, in terms of, let's say, your question, Kev, about buying the company or the crypto itself, I've done 3 bought deals to the company. And, it came in really, really handy because today it was really a great tax loss selling as we're approaching the end of the year, because they all went pretty much bust. So I have a hesitation on all of them. Nothing I'm looking to venture into right away. I'll admittedly say that was probably my own due diligence issue and putting a little too much trust in a broker at a time where there was a bit of a bull run. So I would say it's a pause for me, and I'm kind of sitting on the sidelines as well.
Yeah. My crypto view is so boring. This is coming from a guy who, I used to be obsessed. That's where this whole thing started. Edge Investments was crypto source back in the day. And I put that ebook together, and almost like in that process, it actually made me, in a way, like most crypto less, with the exception of Bitcoin and Ether. I'd say hold 5-10% of your portfolio, depending on how bullish you are, in the coins themselves, in cold storage, just like you said, Dan. And then I kind of just leave it there. Where I'd be curious with the miners is like, it's a business model. It's a simple business model, but obviously in terms of proper transmission and location and cooling and all that, there's complexities in the business itself. Just seeing how much, how sensitive it is to the price of the coin itself is nerve-wracking, because people say that when the halving comes next year and the supply of Bitcoin being produced is reduced, the idea is that the price of the coin goes up. If it doesn't, these miners are all fucked. And sometimes there is a lag. The price isn't necessarily going to shoot up immediately. And it can make these businesses uneconomical in a heartbeat. So it makes me nervous. But then on the other side, if the price, shoots to the upside, which it totally could, then these things can mint cash. Like Marathon hasn't historically been profitable, as far as I understand. Correct me if I'm wrong, but I did notice that their most recent quarter ending September 30th, they did turn a net profit, and actually pretty good gross margins too. So you just see the torque to the upside as well. So it's a volatile play, but potentially a profitable one.
I do want to add one thing here, because Kev, kind of building on what you're saying, it is a volatile asset. But I think you have to go back in history and see what happened when the gold miners and gold got its own ETF back, I think it was 1999. The price of gold actually rose significantly. We went from $800 an ounce to right now we're at $2,200 an ounce, right? So I think there's going to be that type of price action. You don't want to own the ETF. Again, this is my personal opinion, because that's just going to chew away at your fees. But if you want some exposure to it, maybe not as a long-term investment, but you want to participate in this price appreciation, you could get some growth. Just wanted to throw that in there. I know, Pete, you wanted to add something to that.
No, I mean, I guess interesting for me comparing to gold. I think gold's a little bit interesting because gold is really not based on what's out of the ground, right? A lot of gold value is still based on things that haven't been mined. And I think crypto isn't necessarily a one-to-one comparison on that. And over 24 years, like I've still been waiting for this gold thing to happen. A lot of people have been saying 3,000-4,000 for a while and still kind of been waiting on that. So I don't know about that. In terms of crypto, the comment before was just curious about that 30% reduction. Obviously, that's one of the biggest expenses to a business, not exposing yourself to the currency directly. Would be curious a little bit more of what type of PR stunt that is, unless they're getting insanely cheap energy somewhere. I don't know how you reduce it by 30%. And then, in their operating model, obviously tied to the price of Bitcoin. For all intents and purposes, should see a little bit of a bump this year, though. If we think of past trends and things that have made it go up and what we're in for in 2024.
Yep.
Yeah.
Okay. I like that. Well, let's move on to our final topic. Declan, you look like you fired up to say something you want to
yeah, if I can I'll just add one last thing. So, based on the information I have right now, the company's trading around a price to sales of 13.49. So just to put it in perspective, NEO was trading at about a price to sale of 1.9. And we're not looking at price to earnings because both companies are not profitable. But the other thing is the company had cash outflows of 756 million. And based on its most recent quarterly update, it only had about 100 million in cash. So if it's trying to sustain its current operations and, how this new injection of cash translate, kind of how that pans out, we'll really see. But to me, that just like raises alarm bells, even from a price standpoint, like how sustainable is a 13.49? Yeah, you may be playing, but I guess if you wanted to, participate in this, there's got to be options out there that are not trading at such a high ratio, because really that just seems tough to sustain over a long period of time. And if you're waiting for the price action to behave in the next year, when that happens, it's difficult to tell. So anyways, that's kind of how I feel about Marathon anyways.
I think those are good points. So that's I believe roughly a $5 billion market cap. So right in that mid cap territory. Okay, next topic that I wanted to get into is we're going to talk about Versus. It's actually pretty cool, pretty smart move. They took out an article in the New York Times, and it was like an open letter to OpenAI, basically saying in your charter, and they quote it, basically saying if somebody has a better mousetrap, we vow to not compete with them. We'll work with them instead, because don't forget that OpenAI is technically a nonprofit. So Versus is under the impression, and their studies, internal studies have shown that they think they do have a better method for it. So they took out this article and basically just trying to get the attention of OpenAI. So cool move. I thought it was interesting. We actually had somebody email us, Leon Goodman, asking our opinion on this. That's why we're chatting about it. So my views on Versus have been very widely publicized. I love the stock. Full disclosure, I own a ton of it. Corporately, Edge were involved as well. My other company, Apollo, were involved as well. We've worked with them as well. So they're the disclaimers. Take what we're saying with a grain of salt. There's some bias. Obviously, we want that stock to go up. But let me quickly give you my views on this article. I thought it was a cool idea. Maybe it's a bit of a publicity stunt. The stock loved it. The stock is firing on all cylinders over the last couple of days after a tough couple of months. So I'm very relieved personally. But I thought it's a brilliant way to one is to get a hold of OpenAI, but two, it's just a great marketing piece. I think people are going to look at it, read the article. It's very scientific. So you're going to have to read it like 4, 5, 6, 7 times if you want to even stand a chance at understanding what's going on here. But I thought it was a cool marketing play as well. And at the end of the day, I'm no scientist. It's hard for me to gauge the software efficacy, but it certainly seems like they've built something that's going to be the path to, I guess, super intelligence or something on that way. Did you guys read this OpenAI article? Anybody here familiar with what I'm talking about? Have an opinion on it?
Well, I'd love to hear from Declan, because he is certainly the most well-versed on what's going on with Versus's actual tech and their AI implementation. And we and him have had some conversations about, generative versus what Versus is doing. So Declan, chime in first.
Yeah. So quick disclaimer too. Versus makes up about 36% of my total investment portfolio. So definitely a lot tied to the business.
Damn.
We'll discuss more about concentration versus diversification later. But anyways, just getting that disclosure out there. But like Kev mentioned, there's three things that really stood out to me within the letter itself. First is Sam Altman, in a recent interview at Cambridge, came out and basically said that large language models, or in order to achieve an AGI breakthrough, you're going to need a different solution than large language models. The second is what Kev said there, where OpenAI's actual charter says that if a value aligned and safety conscious project comes closer to AGI than they do, they're going to join forces with them. So they're essentially like kind of raising the white flag and accepting it. The third part is that Versus is boldly claiming that they have this technology, that they've achieved this breakthrough. And so, for a company of its size to come out and say that, you got to definitely at least put some thought into it. So I think for listeners, it's really important to kind of understand the technology behind large language models and generative AI, as well as what Versus is doing. And so just to kind of give like a quick summary of it all is large language models, generative AI, and machine learning are artificial intelligence that is trained on these really large data sets. And essentially what the AI is trying to do is figure out the various patterns and relationships between all this data. If it does it on its own, it can take some time and slowly compound over time. But through reinforcement learning and through the guidance of humans, these AI can learn this a lot quicker. And it ultimately gets to a point where we have the large language models like ChatGPT that are able to essentially provide an output after solving millions of calculations in really a seamless and instantaneous moment. Now, there's a couple of problems that arise with the building of these models. The first is biases. So to just give a little example, the other day I was using Midjourney to create images for an article. And I was searching up or prompting it with, well, provide me an image of the Robinhood app with Bitcoin in Paris. And rather than it providing me the Robinhood app, it showed me the Robinhood character. Now, one thing that stood out about this, though, is that all the Robinhood characters were white. And, when you think about why that might be the case is because, well, it was probably trained on data where all the stories about Robinhood are with a white guy in it. And so when it actually came out and generated it, it didn't even consider, could Robinhood be another race? That's the data it has, right? So that's the first thing. Second thing is they can lie. So what happened, or hallucinate is another way they call it. But basically what happens is these AI know what they know, and that's about it. And so they have all the information that they have, but beyond that, they're not even able to distinguish what they don't know. And so when you prompt it with a question that it may not have a very strong understanding about, what it ends up doing is going through the same calculations it always does and tries to find the most relevant answer, even if it's not 100% accurate. And so a problem with that, obviously, from like a professional standpoint, is if you're trying to use this information and you're relying on it and taking its word for truth, you can run into a lot of trouble. So that's another thing to keep in mind with that. The third issue is that these large language models don't learn in real time. And so if you look on like ChatGPT 3.5 right now, the latest update was in January 2022. And it can't take in any information after that. So if you try and ask, it'll just spit out, I don't have information on that. So in order to actually update it, you have to retrain these models with the new data that you include. And this can be costly and timely for the company. And then the last point here is, and definitely the most difficult, is the explainability or auditability of this. So you guys are familiar with AlphaGo, the documentary from Google DeepMind. Essentially where, so like just quick summary, basically Google DeepMind created a machine learning algorithm that learned how to play the game Go, which is the most complex game ever invented by humans. And they essentially trained it to a point where it played the world championship in this game and beat it 4-1. So the AI won. Now, I was listening to the Lex Friedman podcast podcast a little while back, and I can't remember who it was, but basically one of the scientists said, like, well, if you look at these games, the AI itself was creating something that, or like playing these games in a way no human had ever done it. So it essentially like invented a new way. But the thing is, if you wanted to go back and study how that AI made or played the game, what moves it made, why it made the decisions it did, you would have to go through millions of calculations in order to actually figure it out. And that's just for one game. And that's the reason that is because every time it performs a task, it's going through all these different it has to go through all the data in order to arrive at its decisions. So the main problem right now, and this is what OpenAI, Google, and Meta are all facing, is, well, they don't really have a solution to overcome these limitations. So what their idea is, well, let's just scale up. Let's build bigger large language models with more data and greater computational power. And eventually we'll get to a point where we have these AI that essentially have the answers to almost everything, but it never solves the real fundamental problems that exist with these large language models. And so where VERSS comes into play here is through their chief scientist, Dr. Carl Friston. He's the inventor of what's called, or the pioneer of this idea called the free energy principle. And from that is derived the active inference AI. And what it essentially is trying to do is limit the amount of uncertainty in a belief. And so I'll give an example that really like articulates this, but when you were born, were you loaded up with a large data set coming into the world? All this information, you had all these ideas, right? No. So the thing is, what happens is you come into the world, you have very limited understanding of anything. But over time, you gain these experiences. You start to learn in real time. You start to develop more frameworks. You start to recognize more patterns. And eventually you get to a point where you can really like function with comfort. And not only that, but you can essentially block out a lot of the stimulation that happens on the world and just focus on what's important. Now, on top of that, the other part is humans themselves can share with other humans their information. And so this is why, like all of us, we don't need to know how to actually start a fire. Whereas, and now we can focus on things like AI and software and technology, is because we've had that foundation and it's passed on. That's essentially what VERSS's AI is doing here. What it is it starts with a very small data set, and it can learn in real time by just taking in and ultimately trying to answer the question or resolve the problem of limiting uncertainty. It faces uncertainty, a certain challenge. Okay, well, through trial and error and through experience, it's going to develop a stronger understanding of that overall. And then beyond that, what VERSSS did before actually creating Genius, their AI, is they created a set of standards and protocols and donated it to the Spatial Web Foundation. And these allow it to do that element where of knowledge sharing, where the AI can access agents and really any Internet of Things device and use that information in real time to communicate. So where it's really neat is like, you could think of it like, in traffic. If all these like freight trucks were carrying around and they experience traffic in one spot, or like say there's a collision, well, in real time, they could communicate and update to each other if these were autonomous vehicles and be able to find more optimal solutions based on that. So, that it's a long-winded answer, and it doesn't really do justice to the technology. Like, I'd really recommend, like, if you want to understand the technology itself, look into Carl Friston. Dr. Maxwell Ramsteed is another guy who works for VERSSS, and also like try and read the actual book Active Inference by Carl Friston, because that's where you get the nuance of it, and it's a tough read, but that's why they're actually able to come to the table and say, hey, we think this solution, we have real-time AI that can work together and interoperable. And sorry, the last thing is the explainability through the standards. They can actually communicate laws and values to the AI itself, which is a big thing, because ultimately we don't want to create terminators that go and destroy us. We want to be able to communicate to the AI and AI communicate back to us how to actually comprehend these things. So I apologize for the length of that, but I felt like it's necessary
Gotta
for
give Declan
listeners to
some
have that info.
credibility. We
love it.
got to give him a round of applause, though, because if that's 36% of his portfolio, he's clearly done his research. So well done. Well done. That's a good sign,
I
right?
did
Like when
a
somebody
little-
knows so much about their company and they've invested that means they understand it. So good on you, Declan. That was really informative.
No.
This is
Appreciate
also
it.
a
Thank
stock that I thought for sure, Mr. Fundamentals would not like. You know what I mean? It's
Based on his crypto answer, right? Totally.
yeah, exactly. Which is funny, but then you see what I'm saying. As you learn about this story, you realize it's one of those things that's virtually impossible to value now, because good for them. They do have revenue. They have they sell stuff. Like it's a business that works.
Yeah.
But the moonshot is like building this whole next generation platform for doing AI properly, like modeling it after a human brain. Like I think of this when I think of large language models, I think of somebody walking around with like an enormous head, like just an unnecessarily large head, because the idea is you want to get this guy smarter, you just stuff his brain, but then eventually you're walking around being crushed under the weight of this massive head, right? Whereas Versus is going for an approach that, like you said, can in real time look at the world around it and basically use math to like best estimate, what is true, and it's a completely different way to do it. Because I wanted to punch in on something you said about training these large language models. It is unfrickin' believably expensive right now. GPT-4 cost OpenAI $100 million to train, and basically GPT-5, like, sure, it's on the horizon, but it's almost like not. Like they're basically saying no time soon, because what's the next step? Do you 100x the data set and spend 10 times that on training it? Mind you, the price for training these models is going to come down significantly in the next couple of years, but it's still going to be expensive, and it's always going to be expensive. So Versus is like a ground zero approach to a completely different, much more efficient way of building this intelligence. So, and I did a little back of the envelope math. I'm sitting at about 25 to 30% of my portfolio in that one stock too. So I'm right there with you, man. Let's go.
Let's go.
Yeah. Well, Declan, great explanation. Again, disclaimer, I was part of Versus IPO, and Kevin and I also are holders of Versus in our shared portfolio. And we are almost comically long on this when we have any portfolio discussions. If I went through any time we're thinking of making a move or anything, every text message this year is, but not selling Versus. So, I think we definitely really believe in that. And I think it's interesting of what the definition of AGI is to some, because I think there is something that we're going to see in between, which is retrieval augmented generation. And that's what's going to be layered onto the LLMs. And picture that as your personal knowledge base that creates certain information to an LLM. So a very interesting example for that, for me, is you can do this now. This exists. You can talk to a lot of tech companies and say, this is all the data. This is all the information I have. A lot of companies are investing in this. And it is very similar in a sense that it is feeding a set of numbers in the relationship that LLMs use in vector embedding from 0 to 1, but it's a layer before the LLM. And I think this is actually a next step, and I don't know who's going to commercialize it, but I'll give you an example. Every email I've ever written, I think I got my first Gmail account in 2006. I don't delete my emails. I'll just archive them. They're all there. I can create that in today's technology as its own knowledge base. How Peter writes, how Peter responds to things, how he thinks, how he's evolved. And I can instruct the LLMs to actually pull from that knowledge base and then eventually create its own guardrails, right, of certain things. But that could be an ultimate productivity tool. It could also be a very risky tool if it got in other people's hands. They could say, what does Peter think about this? And it would probably say it with great certainty. So you would actually have to create a lot of guardrails before you release this. But this is something I see coming much sooner than later. A lot of Fortune 500 companies are implementing this. And it's something I think you're going to hear a lot more of, is retrieval augmented generation that's going to be layered into LLMs. And I think that's definitely a logical next step. before you're seeing any type of AGI. And I think that's something you're going to see a lot more of in 2024, because when you start going down that rabbit hole, the possibilities become endless in a sense of what you can do to plug in a personal knowledge base, a corporate knowledge base into an LLM. Because for every reason Declan just said, if you don't instruct it, they call it, hallucinating. It will lie to you. But, how you prompt a human might be the same way. If a human will talk about something they're not an expert in, if you just say, what do you think about this? It'll give you an answer. Now, if you say to the human, but don't lie, it'll give you a different answer. And that's what prompting these LLMs are. And, Declan's right. It will only ever be as smart to a certain point, however much information we kind of put into it. And I think obviously where it's citing things, how it's doing that is still a bit of a black box in a sense of machine learning, because it can go down so many different ways. It will never truly be able to kind of cite everything. So that's also a bit of a concern. And I think LLMs, I think, are a little more similar to human learning in a lot of ways, that they are going to have bias from authoritative sources. Right. So the way it spits things out is if it sees similarities from certain things that it has deemed basically authoritative enough based on these human corrections and where it's citing from to kind of get better. But I see things layering onto LLMs as something that's going to become a lot more common. And I'm just interested of what the commercialization looks like right now, because it is a tech project for companies right now. It's not something you and I can necessarily go have access to. But I think you can see that the longer the prompt you put in, the better response you get. So think of it like that, but you're tying in a personal knowledge base or a corporate knowledge base. And that then is layered into an LLM that's giving you an answer.
Mm-hmm. Mm-hmm. Well, I think that's something that I love so much about the Versus approach. It's where they're going to make these agents that the best way I can, like in my mind, I basically call them super apps. It's just like, imagine you download Expedia on your phone and you type in, I want to go from Vancouver to Hawaii on these dates, whatever. And you're basically doing it yourself. But what happens when you have one of these like intelligent agents that is already connected to your calendar? It already knows that you're going, read your email and it knows that you're going for work, et cetera, et cetera, et cetera. And you basically open this app, if you will, agent, and it's already, it'll spin up, it'll say, this is the flight. Like, this is the one flight. I've looked at everything. I know everything about you. I know what you're going for. Like, this is the one flight, right? It's just like you type in on Google and you get a full page of, 10 articles that you can read through. Well, in the future, you're going to have like search agent, and it's just going to instead give you the answer. So these like siloed agents that, well, they're not siloed. These individual agents that can connect with each other are just going to completely change how you interact with, picking up your phone. It's going to be a totally different experience. And to your point, Pete, talking about, corporate data sets, because most data is not publicly available. You can't just like go on Google and see, Faskin, the law firm. You can't go and access their data. But Faskin could have an intelligent agent that can work internally on their data. So you're going to get these unbelievable insights that I think we haven't even come close to where this could go. And maybe one final point. Now I'm ranting. It's Versus. It's that passion, baby. But they had like the announcement today about Volvo signing up for their beta program. NASA also signed up for their program. So they've got these like mega names where you look at a piece of tech like this, and the first thing you should ask is it real, right? Because it's easy to be deceived by sexy market timing. Companies raised a lot of money, so you assume somebody knows something. Then the CEO is very suave, but it can be easy to get swept up. So for me, when the thing that gives me comfort is, well, one, they have revenue. They've actually been actively selling their Wayfinder product. Two, Carl Friston is one of the most cited and respectable scientists, relevant scientists that there is. And three, you're seeing these massive corporations like Volvo signing up for the beta program. So you can be like, okay, I feel relatively certain, that there are people who know this better than me, and they're putting a bit of a, do I say endorsement on it, or it's a step in that direction, right? But that's the first question you got to ask with these.
Yeah, absolutely.
I'll kind of leave it everybody with a cliffhanger here, but I'm not in the stock. I've been watching it since it got traded, and then I saw it fall off a cliff there at $1. in October, and I was like really considering to buy it. I waited a little too long and saw it shoot back up again. So clearly the shareholder base is really strong. Awesome. That's very exciting.
It is.
Yeah.
If you're not using AI, I think you're falling behind, right? So you got to adapt it into whatever it is that you're doing. So that's kind of my take on here. I'm no expert in anything that Declan was talking about, but that just piqued my curiosity. There's a lot to learn in this space right now.
Yeah. Well, Dan, if you're curious about the moment that the stock fell off a cliff, it was actually the exact moment I signed my name on the subscription document to invest. The thing just cratered immediately. Like, oh.
You just buy when nobody wants it, and then you're riding that thing up to the moon, as they say.
Yeah, but we're back now. We're good. This has been a really, really good week for the stock.
Yeah,
so we're back.
Yeah.
Okay, I think we've kind of exhausted that discussion there. If anybody's watching, really interested in Versus, you should be. We have 2, if not 3, previous interviews with Gabe, the CEO, that are really, really, really good. And we took a full hour, each time full hour, going deep into this stuff. Nobody tells it like Gabe. He is a savant, and just really fascinating, interesting to listen to. Go watch those. Let's wrap up Versus for now. One final discussion, which is like a perfect way to segue into this: diversification versus concentration. Mr. Fundamentals just dropped a hammer here. I thought for sure you'd be like, what's that perfect number of stocks? Is it 24? I want to say something in that region. Does anybody know that number? It's like the optimal diverse number. Do you know what I'm talking about?
64.
I've got a stat that I'll drop a stat on you guys. If you want right now, I can kind of like highlight anyways, if that's all right. But so Joe Greenblatt, another big fundamental investor, and he created the magic formula, and he wrote the book, like the little book that beats the market and stuff. And anyways, he pointed out, basically he ran a study that holding 8 stocks eliminates 81% of the risk in owning just one company. And then holding 32 stocks eliminates 96% of the risk. Okay. So after that point, the risk is very incremental. So that kind of feeds off anyways what you were saying.
Yeah, that's exactly. I was just Googling it. Yeah, 25 to 30 companies, but I knew there was a specific number. So I think you're right, 32. Right. So I don't know if we debate, maybe we have different views here. I'll kick it off with my personal view. I would say my portfolio has always been quite concentrated. From the public equities standpoint, I'll maybe have between 10 and 20 at any given time, but then I also own other assets like private companies and things like that. But I've always been very concentrated, very high risk. I'm not looking to get my 5-10% growth per year and, until retirement. I'm looking to make some big wins. As I get those big wins, transfer them to a lower risk portfolio. So I personally am 100% in the concentration game. Look at guys like Mark Cuban. He's like a very active, very vocal advocate for the concentration approach. But I think what it comes down to is what do you want? What's your goal? Are you creating wealth or are you preserving it? If you're preserving it, you got to be diverse. I think everybody knows that. If you're creating it, being diverse, you will never create wealth. It's very, very difficult. Unless your time horizon is 40 years, which mine is not. So, that's my personal view anyways. I don't know if anyone disagrees.
No, I agree with that, because last year or 2 years ago, when oil and gas stocks fell off a cliff, I had about a 60% concentration into that sector. And that actually contributed to a significant growth in the TFSA, the RSPs. And then I started trimming, when everything was kind of rallying into rally mode, they sell the rips, as they say. I still own some exposure, but it's not as big, right? You still want to be in that concentration. But I think when you start diversifying too much, you actually kind of limit your growth. You got to ask yourself the question. It's what's your goal here, right? I think we're all under the age of 40 here. So we still want some risk. We still want some concentration, right? So Declan's perfect example. It's he loves Versus. That's AI. For me right now, it's crypto. Oil and gas is still part of that. I have another AI name that I have as well. That makes up about 40% of one of my portfolios, right? I don't like that diversification quite yet, but now since bonds have been coming yields are coming down, you want to have that long-term bond exposure because that's going to, you're going to see bond prices go up. So add a little bit to that. But I've never believed in like total diversification. I think you want to have some concentration to really boost that growth, especially on the especially early on as you're building your wealth.
Yeah, I'm the oldest one here, so I'm starting to move towards some diversification. I've had a few times in the past few years where I've been concentrated to certain industries. And I think you have to realize that some of them obviously have some inverse relationships. So there is certain amounts of hedging risk of when, one specific industry or something is going up, naturally another will fall. And it's okay to put a certain percentage of your portfolio, and you should, into kind of some well balance. But I think someone might need to fact check this while I say it. But the case in 2023 for concentration, I believe 88% of the gains on the S&P 500 this year were because of 7 companies.
Yeah, I know.
I think it came back to life, and the top 7 companies were responsible for 88.
Meta, Facebook. Yeah.
I have a chart too that says that 71% of the S&P is from the Magnificent Seven. The rest is like 6 or 8%, or something like that.
So, and I think here's the thing: if you're an active investor and you are watching things and you're willing to take an example of trends and what's happening, concentration is great. If you're looking to be passive, you better be diversified, because if you're going to take a couple of weeks off, if you're actively managing your portfolio and you don't have a great investment advisor who is obviously going to diversify, I don't think they have kind of their own guidelines at all the banks, at least in Canada for sure. If you're actively managing this yourself, you better stay on top of it if you're concentrated. Because, if you're in under 7 companies for your entire portfolio, and any news, any mismanagement there could have really big consequences.
Yeah. Well, I made a mistake of getting too diversified in my penny stock portfolio. So what I find is, like, specifically with penny stocks, like, these are things, set it and forget it is your worst nightmare. That's an easy way to lose all your money. Like, you need to be so dialed in to these companies, knowing when shares come free trading that are going to, come cause a sale wall. You want to be watching insider trades. Like, you just need to be dialed in. One good piece of news can send the stock up, 2-3x at times. So for me in the bull market, I feel like I was probably signing a subscription document like every week at least, and just adding companies like bang, bang, bang. And I got lost in all of it.
Yeah.
I did not keep track properly. I forgot, holy shit, I got to exercise my warrants on this one before they expire. This company just had some like terrible financials and I missed it completely. Stock cratered before I could buy out. Like, you need to be so dialed in that I find, for me personally, in my penny stock bucket, no more than 10 stocks ever. Less even, 6, 7 that really well. Yeah. Are you okay? Yeah.
Yeah, I think that's a better number, actually, because I think there's some of them you might need to get out. We all know that. We all know in the smaller cap space, there's a lot working against you, and it'd be better to roll that 5 into something else if you're going to be concentrated, and especially if you're looking at sub $80 million companies. I think in that line, you have to kind of pay attention to this, because there's people that are very aware of a cash flow situation that, if you're looking at their quarterly earnings and they're out of money, well, a deal's coming soon. That's it. There's no two ways about it. It's either bankruptcy, debt, or a financing.
Right.
All of those are going to affect the stock a certain way. And I think, as we continue these discussions and these weekly podcasts, I'm happy to kind of teach our audience a little bit of where to find out that information and how to properly read a cap table, because I'm sure a lot of people aren't looking at this and understanding when things become trading and how that can certainly impact us. Yeah, exactly. So when things get released, right, that can have a really big issue if there's things on the cap table that are a cent, a tenth of a cent, or a hundredth of a cent. I think people need to understand that. So if you're concentrated in penny stocks, and if you have any type of a job, you can't cover more than 10 penny stocks.
Yeah,
Sorry,
no way.
There's too much happening.
You know what,
yeah.
Dan? 5, I think that makes more sense. Just like you said, Pete, if you have a job.
Yeah, if you have a job.
If your job is this, then fine. go a little higher.
The only reason I said 5 is because one of them is in my penny stock portfolio is delisted, but that's just the game, right? That's why you manage risk accordingly.
Oh God, I've got a few of those.
Yeah. I'm just going to chime in here a little bit. So this statement might kind of trigger some listeners, but this is like directly from the Oracle of Omaha himself. He basically just said, like diversification is a protection against ignorance to some extent. And, it makes little sense to know what, or sense to do it if you know what you're doing. And I do very much share this belief. So the common lingo within the institutional framework and even in university, how I was taught is risk is associated to the volatility of a company, how much it swings up and down, and that deviation from the S&P 500 or a major index. Now, I would argue that that is not the case, or it plays very little factor into it. Really, what risk is both from a fundamental standpoint, how durable and strong the business is. From a valuation standpoint, is the price attractive? And then lastly, how much emotional fortitude do you as an investor have? So it's a lot easier to keep your emotions intact when you know a lot about the business. The greater you understand the business, the ins and out, how it's doing, if it's fundamentally performing well, it's a lot more difficult to become susceptible to your own emotions. And like, for an example, like Versus, I think 6 months ago, like it went from 350 down to 80 cents. And throughout that time, as an investor, I was holding. And, maybe you would start to see that price action and say, like maybe there's a problem with the business itself. What if I should sell out? Is there an issue here that I should be more concerned about? On the other hand, if you see that and that company goes down to a price to that range, but the fundamentals are intact, the valuation is still attractive, it still looks cheap, and the business is growing internally and organically, that should kind of like rewire your mind to say, you know what? Instead, I should put more money into this business. I should double down on this because I have this strong conviction. Now, there's of course, you're never going to be 100% right or certain. So there is always risk, and that can happen with any business. But really the way I see it and like why concentration is important is, you maybe have like say 5 to 10 ideas that are your best ideas. You know a lot about that company, or you have a lot of conviction anyways. And every time, like for me right now, when I try and weigh one of my companies that I'm currently invested in against another potential investment opportunity, I always find myself like finding the ones that I own more attractive. And so rather than like spreading out that money and allocating it to weaker conviction bets, I'd rather just put it into those companies that I have the most conviction. And so that's really like where I come from is, if you take the time and to your point, Pete, like if you are working, it's very difficult. But the reality is if you want to achieve like outsized gains and, beat the market consistently over time, you got to put in the work. It's the only way as an investor, you have to be able to learn and develop your skills. If you sit on the sideline and you're like, you know what, I want to grow my money over time, then maybe the best option is to, like you said, do a more passive approach, buy ETFs, take on less risk that way. But, again, if you want to achieve like financial freedom faster in that extent, or at least like compound your money quicker, you got to put in the work. Whatever strategy you propose, you got to buy in and do that. So, yeah.
Yeah, absolutely agree. I think for sure, if you're going for a more concentrated route, you should probably be able to read a prospectus. You should probably have some type of a skill set there, that understanding of how stocks sometimes aren't necessarily always tied to business performance. Emotionally, being concentrated is quite a ride, boys. Got to tell you. The good and the bad is such a ride, because and how fast things can go up or down. When I've had times where I've been more diversified, you'll see some things that shot up, and you'll go open up your portfolio, and you're like, oh well, something shot right down too, and maybe you're only up a couple points. But when you're concentrated, you can have some swings.
Indeed. How I do it, I've got essentially two buckets. I've got my wealth creation portfolio and my wealth preservation portfolio. Now, for preservation, I don't even manage that myself. I've got an advisor, Bank of Montreal. You'd still consider it a very high risk portfolio because it's all equities, but they're like mega caps. Like it's like Apple. Those companies that I just don't have much interest in, like researching myself. I just feel like I have no competitive edge over any other analyst. So I let him do that. I expect that to grow at a steady clip. I don't even always know what's going on in that portfolio, and I don't care. I trust him. I'll look at it yearly. I talk to him more often than that, but then I have my concentrated portfolio, which is where I make the money. And it's very concentrated. It can be between 5 up to 15 stocks, regrettably. But in those companies, I know very well. I'll know when shares are coming free trading. I know the management personally. I call investor relations. I could probably recite large parts of the prospectus to you, and I know the financials. So those would be the difference of how I play it. And as I make money in the risky stuff, I go send it over to the safe stuff to preserve it. And that's worked well for me. Any final words here? Should we wind this down for the week and conclude episode 3? Not all at once.
I think it's good.
We are. Yeah.
Well, I was just gonna say. I mean, it is Christmas, so Merry Christmas, Happy Holidays, and
Merry Christmas.
Next year, if the market melts up early on, I wouldn't be surprised. But those rate cuts usually signal the top of a cycle. So maybe small caps 2024 is the year of small caps. Who knows? But time will tell, I suppose.
It's coming back.
It's coming back. There's life out there. Amazing. Well, boys, thanks so much for joining me. Those of you guys listening, this is episode 3 of the Beyond the Edge podcast, coming to you every week, recorded on Thursday. We drop them on Sunday. If you're in our email newsletter, Sunday Snapshot, you'll see this link included there. But please subscribe on YouTube if you haven't already. Gentlemen, thank you for coming. Happy holidays. Enjoy your weekend. Cheers, guys.
Cheers.
Happy holidays. Cheers, guys.